So this should be a quick video. I want to give you folks a very simple, easy to understand, very little moving parts strategy that you can implement today, right here, right now, that you can go out and test. So let's talk about it. We're going to use this USD from, and I know I'm in replay right now, but just to show you the receipts, this was plugged real time in my chat room in the 1% club, but also in the free chat room as well, right there. And if you do want to join that free Discord chat room, there's going to be a link to that in the video description. So here's the deal, folks. We've talked about market sucker shifts before. I have videos on market sucker shifts and different variations and different ways to trade market sucker shifts, because there's a million different ways to skin a cat. But what we're going to do here is I'm going to show you something that you can utilize with that. Another way that you can get much higher probability deals. You see how that came down? And this took out major liquidity on that push lower. Had a big flush, and you see that cleans out this higher time frame sell side right here. What makes that higher time frame sell side? It's on the 4 hour, and low slow in the middle, higher low on the left. Look at my cursor. Higher low on the left, higher low on the right. That candle to the left, that candle to the right is higher than the one in the middle. That makes this a swing low. Okay, so that's a swing low. There is liquidity, major liquidity residing beneath that level. That flushes and it comes down and it takes it out. It takes out that sell side, right? Look, follow my cursor. That push right there, that push lower takes out all this liquidity in here. Okay, so when I'm saying like liquidity, put simply, look, you got a swing point. There's liquidity residing beneath these swing points. And you see how that comes down and takes that liquidity. I want you to think of liquidity as the fuel for price. I want you to think of it as the fuel for price. Okay? That's going to fuel the push up. So price comes down and it collects that fuel right there. It cleans that thing out, right? And then what happens next? This right here gets a leg up. I want you to go in here, because after it cleans out that liquidity, because we've talked about in regards to a shift, it's like step number one is you need a lot of liquidity taken. Okay, so we have liquidity taken, significant liquidity taken to frame the shift. You need liquidity, and you need the displacement leg, you need the fair value gap, and you need the strong close on the displacement leg. Now this did right here, it did push up into a 15-minute premium. So it's not perfect, but when you utilize the signature that I'm going to give you right here, and now when I say this, I'm not trying to like create shiny object syndrome, because now there should be somebody's like, oh, I want to do this now. And so now you're saying you don't need a premium. There are different variations of market sucker shift deals. This is still extremely high probability when you have this scenario. And here's the thing, like I'm not doing all this stuff on this channel to like give you that, like for you to try to do everything all at once, right? That's not my objective. I'm giving you like a buffet, so you can go in and you can choose what you want. You can choose specifically what you want to focus on, and then focus on it, whether it's candle confirmation, whether it's market sucker shift deals, whether it's the 15-minute, whether it's the 1 hour, whether it's the 5-minute. I want you to pick one and focus on one. I'm doing this because I'm giving you different options. I give you different things to test. Now, there's nothing wrong with testing different things, right? Like taking one model that I talked about over here, and then taking a different model that I talked about over there, and then testing it, and then seeing which one yields you the best result, or which one fits you and your personality, and then going all in on one strategy. And you can build later, of course. That's my objective here. So I want to make that clear when I'm doing this. Like that's how I want you to approach this, okay? Because there's different variations of this stuff. Because when you add in the third candle here, which is going to be kind of the topic of this, it's going to make it so much better. That cleans out liquidity. So we have significant liquidity taken down there with those swing points like I talked about. You get the displacement leg, you get the fair value gap, which is right here. And again, I'll leave a link to my video on fair value gaps in the video description if you don't know what fair value gaps are. But put simply, 3 candles, follow my cursor, 1, 2, 3. The top of that first candle where my cursor is now pointing, and the bottom of that third candle where my cursor is now pointing, you see how they don't touch and it leaves behind a gap? That's a fair value gap. Okay. And if you're familiar with SMC, you know what a fair value gap is. But I'm talking about for the folks that are not familiar with SMC, smart money concepts. So we got the strong close with the short-term high too, which you see is like right here. Highest on the middle, lower high on the left, lower high on the right. That is a short-term high right there, folks. And you see how that got a strong close above that short-term high? That's a confirmed shift. Fair value gap, strong close above the short-term high. You have the liquidity run. Okay. And what is the other thing that I've talked about in regards to shifts? If you've watched other videos, you need an opposing draw, right? You need an opposing draw on liquidity, because that's where folks go wrong. That is where folks go wrong, is because, or where most folks go wrong, because a lot of folks, they understand liquidity, or the liquidity aspect. Okay. So they understand, okay, we need a lot of liquidity taken. That's pretty simple, right? Pretty easy to understand that. Everybody basically understands like the fair value gap. Like you need the fair value gap, you need the strong close. Pretty easy to understand that, right? Where a lot of folks go wrong is, yeah, the premium and the discount does a lot of folks in, but also the opposing draw. Because in this case, it did come up to a 15-minute premium momentarily, then it pulls back down to a discount. But what helps this and what makes this a bit different is you have the third candle draw in here. So here's the thing, folks. With your shifts as well, something else that you can do. And when I say third candle draw, what I mean is, and I've talked about third candle draw on this channel as well, but it is the third candle of that swing point. What you need to understand is the third candle of the swing point, of a fresh swing point, is extremely sensitive. It is a powerful draw. It is a powerful draw. So I just said you need an opposing draw, right? I just said you need an opposing draw. That's your opposing draw. It's the third candle draw. So when you have the liquidity freshly, I don't think that's a word, but freshly taken, when you have the liquidity taken like that on that push lower, and then I'm talking about right after it, you put in a swing point. That candle has to close. Okay, that closes at 5 o'clock. That opens up if you look at the little black box at the bottom of my screen, it opens up at 4 o'clock a.m. Eastern time. And it closes at 5. You need to see it close, and you need to see it create a new swing point. So when that happens, you concluded right away, I have an opposing draw. And that is the missing thing that a lot of people don't have when they trade like shifts. They don't have the opposing draw. I've given you tips as well as like in regards to like premium discount and like in the previous video that I made. But here's another thing. Third candle draw is a very powerful magnet for price, folks. So you have the liquidity to fuel that push up. And now you have an opposing draw being the third candle draw. It is also important that that right there is not taken out buy side, look like major buy side liquidity. What do I mean when I say major buy side? What I mean is you don't want to see it come up on that third candle and take out a swing point. When I say a swing point, I mean a swing high. So high is in the middle right there, lower high on the left, lower high on the right. For example, that's a swing high where my cursor is pointing. You see that? For example, over here, that's a swing high. That's a swing high. So on the push up that you like, look at my cursor, that creates the third candle, you don't want to see it take out a swing high either. Okay. That is very important. So you want to see the liquidity taken like this. When I say liquidity, like it doesn't necessarily have to be like a super giant level, but you need to see it come down, take out sell side, right? Of course, the bigger the level, the better, but you want to see it take out sell side like this, run out liquidity. And then you want to see a new swing point taken. In this specific, this is different from candle confirmation. Like you don't need a strong close for this scenario, okay? And that's why, right there, folks, on this particular day, you were not seeing me talk about candle confirmation to the downside there because I understood this was happening. You see, because you see the strong close, but that's not a candle confirmation deal you want to partake in. You see, so you don't need a strong close in the third candle because I know that question is going to pop in somebody's mind. Do I need a strong close? You don't need a strong close. You need to see liquidity taken, major liquidity taken, and then you need to see a new swing point put in, like you see here. That closes at 5, and then what you need to do is you need to go into that candle, and then you need to see if you got your confirmation signal, the fair value gap, the strong close. You see, and then you can look for an entry. So like that opens up at 5 o'clock because here that's how I approached it on this day. What I did is after I got that, I hopped in it because here's the thing. You see how it's in a discount too, so you can enter at a discount. You don't got to, but I'm giving you like a very simple way to go about doing it. So there's a discount. See that right there? See that 50%? You could enter right there. And then you could risk that low. And then you could target that high right there. the high of the impulse move. You see, that'll give you a simple 1-to-1. Now, for the folks that are familiar with my content, you know I love 1-to-1. But for folks that are brand new here, they're thinking, did this guy just say 1-to-1? Because a lot of folks have been brainwashed by gurus that they need at least 2-to-1 or 3-to-1. You know, all the marketers that most of them have not made a single dime from trading, but only from selling courses. That's what they all tell you, right? That you got to have bigger winners and losses. It's complete BS. Okay, you can absolutely clean up with a 1-to-1, but if you must have your bigger winner, then I do recommend watching my other videos that I made on market structure shifts as well, which I will link in the video description below, because I've given you other options about how to go about shooting for bigger targets. I have taught you that, about how you can do that, because you can make money with bigger risk reward. I'm not saying you can't, but I'm saying don't sleep on 1-to-1. Okay. But that's an option. But real briefly, another way that you can go about doing this, but understand what comes with bigger winners, folks, is you're going to take more losses. That's the trade-off. Okay. What you can also do is you can utilize like a lower time frame. So like say you get that there on that 5 minute, then you can go down to like a 1 minute, wait for a pullback into a discount on the 1 minute. And you could do it like this. Like you could wait for like a 1 minute displacement because price is fractal. And then you could wait for like a 1 minute shift. And then you could do it like that and then just risk the low of the 1 minute. And then run out the highs if you want bigger risk reward. That's another way you can go about doing it. But I do recommend you watch my other videos on market structure as well. If that's if you're kind of looking for bigger winners, then watch the other videos, because I do got some options for that as well. Some options for you on that as well that you can utilize. But I'm giving you like that 1-to-1. That's a very simple way to go about doing it, folks. Very, very simple. Of course, you can utilize this on different time frames. I'm using this time frame right here, but you can use it on the 1 minute. You can use it on the higher time frame. Price is fractal. It occurs on different time frames. All kinds of markets, crypto, forex, futures. It does not matter. You can use it in different markets, different time frames. Just look for that specific signature that I taught you right there. You need a liquidity grab. Okay. You want to see a fresh swing point. It's key that it's a fresh swing point. Okay. This setup specifically that I'm showing you right here, it needs to be a fresh swing point. Otherwise you don't, it's like that is required for this specific setup that I'm talking about. Okay. A fresh swing point. That's what I call third candle draw, is a fresh swing point to high that candle. And of course you would just reverse this for a bearish scenario. It'd be a fresh swing high level. You see? So for example, highest high in the middle, look at my cursor, highest high in the middle, lower high on the left, lower high on the right. Okay. And then you see how you got like the low of that candle right there, third candle that it takes care of right there. Fresh swing point right there. Or over here, for example, lowest low in the middle, higher on the left, higher low on the right, swing point. So that's all it is. It's just a third candle draw. That's what I call third candle draw. It's a fresh swing point. And then you go in there, and then you look for your shift within that. You look for your lower time frame shift within that, and then you take it up into your opposing draw, which is the third candle draw. See how simple that is? It's so simple, but so effective. I'm telling you, it's so effective when you do this. You don't get setups left and right though, but that forces you to exercise some patience, and that is good. That is good, because you don't need to. You don't need to be taking trades left and right, folks. You just don't need to. You can make an absolute killing off of just a few trades a week. Y'all know I used to, like, I trade a lot more. I'm a lot more of an active trader now. I do typically trade every day. But I used to take, like, if you've been with me for a while, you know I used to trade like 1-2 trades a week at one point. So I'm telling you, it doesn't take much. So that just gives you something to go test. Go test, see if it fits you. And yep, so I hope you enjoyed, got immense value. If you did, leave a like, subscribe to the channel. See you later.